Should you pay your mortgage off early or should you accelerate payments in any way? We have a ton of people all year long for my entire career that talk to me about different strategies around paying off their mortgage. Would it make sense for them to make an extra payment every year? Would it make sense for them to do a lump sum payment over the course of whatever amount of time? Would it make sense for them to go to a shorter term mortgage? So, even though you're not paying your mortgage off with accelerated payments, if you go from a 30 year to a 15-year, you're still opting to pay more towards your mortgage to pay it off earlier. And should you do that? Well, the answer is it depends. So you can get online and talk to and find a bunch of people on Instagram, influencers, TikTok, whatever else, and you'll have a group of people that say you should always carry that debt. You should never accelerate it. It's a bad idea. And then you're going to have another group of people that are going to tell you, oh yeah, pay off all your debts. You got to be debt free. Don't owe anybody. And the thing is, up until the time that you have your house paid for, you still have a lien on that house. So whether you owe $1,000 on it or $400,000 on it, there's a lien on that house. And if you fail to pay, whoever's lending you the money has the ability to execute their lien and foreclose on you. And who do they want to foreclose on the most? Realistically, a bank's probably more likely to foreclose on somebody that has a lot of equity. And that might ruffle some feathers of some bank friends of mine. But does it make more sense for someone to or someone from a financial standpoint, a lender to say, you got $300,000 worth of equity, or you have $3,000 worth of equity? Which one is more likely they're going to work with you on your payment or whatever else? So here we are down to the question. So the answer is maybe. So number one, I have an overall 7-step process that I tell people to follow before they're going to make a decision on whether or not they should accelerate their mortgage at all. Number one is, do you have any non-tax advantage debts? If you have extra money to pay towards anything, but you're carrying some credit card debt, you've got some other bills that you're paying interest on, it makes absolutely no sense in the world for you to want to pay more towards your mortgage to eradicate that interest if you're willing to pay interest on non-tax advantage debt. So that's number one. Number two, we want to get into, do you have enough liquid savings? So if you're accelerating your mortgage, but you're in a situation where you might have to dig into non-tax advantage debt, you might have to dig into credit cards, might have to take out a loan in order to have living expenses, or you might be in a situation where you want to pull equity out of the house because you can't afford living expenses again. It doesn't make sense to put all that money in there in the first place. So second thing would be liquid savings, and how much you need is really dependent on your personal preference, but also on your career path. So for me, I've been a 100% commission person since 2005. And my threshold, and I've never been in a situation where it's like, oh my God, I got to dig into my savings. Yet my risk threshold for having liquid savings is not great. So while most people might be good with 3 or 6 months, I have more than that because that's just where my comfort zone is. Third, emergency savings. Do you have enough emergency savings? So liquid savings, emergency savings, they're separate things. Like, oh my God, we went through the liquid. Liquid's going to go up and down all the time. Emergency is, boom, I got 3 months of living expenses no matter what. So if it all falls out, I have some money to fall back on. Are those things funded? If those things are fully funded where they need to be, okay, we can move on, or partly we can make sure step 4 is done, and that's insurances, disability insurance, life insurance. The most common reasons why you lose your assets and why you might lose your house is usually because a loss of work or, unfortunately, a loss of life of one of the spouses. So if you have a bread earner that hurts himself, or him or herself, that cannot pay anymore, you need that insurance to cover that. And you should be paying for that ahead of time, not accelerating your mortgage payments. So we've gone disability insurance, life insurance. Now we got to talk long-term planning. So again, if your long-term plan is to pay off your mortgage so you have a free place to live where you're just paying taxes and insurance, and trusting that you're going to have enough money from Social Security or whatever else to live, that might not be the best idea. You're probably going to want to be putting money towards those things and maximizing that long-term savings before you're slowing down your mortgage debt. So after that, I would say fund money. So if you're somebody that likes to invest in other real estate, if you're somebody that likes to do, investing in stocks, whatever else, you got to have some money to fund those other investments that might be a little riskier to you, like money that you're not worried about necessarily losing. So that would be the last step. And then your house. So if you have all these other things in place and then you get there and you still have extra money in your cash flow, lowering your mortgage debt to me would be a great idea. There's no sense in paying interest on anything, outside of the tax advantage if it's not going to help you there. So at that point, so it's really specific to person to person. If you have somebody who's like, I want to save all this money because I want to have a really big fund money account because I want to go buy other real estate and want to build long-term wealth, that's good. But let's also remember that you have, if you have $200,000 in the bank and a $200,000 mortgage balance, you still have a net zero balance sheet. So you don't have $200,000 debt when you have this other stuff. So the whole idea here is to make sure that your net balance sheet grows. So we can't get too worried about what the debt is so long as our other positive investments make. Same situation. If you do the strategy where you're paying yourself first and you have $200,000 sitting here, and then you're like, oh, but what happens if I lose my job and I can't pay my mortgage? But you have $200,000 to continue to pay that mortgage or pay it off, even if you had to. Like, you have the money, you're still in the same boat. So you don't necessarily have to worry about that because you've protected your assets that way. So last thing I'll leave you with, 3 key things of an investment. You want to have, is your investment liquid? So your liquidity, your rate of return, your safety of principal. So when we talk about home equity, it's not liquid. When we talk about home equity, it doesn't have a rate of return. When we talk about home equity, the safety of principal is completely contingent on the market. So if we had another complete market crash, if you bought a house for $500,000 and the market crashes and it goes down to $250,000, you've lost $250,000. So if you have now paid that off faster because you didn't want to have that debt, you actually lost the money if you are forced to have to sell for any reason. If it's on paper, you just have a negative balance sheet, but you still have money that you can put towards things. So anyone that has any other questions about or even wants to debate me on whether or not you should pay off your mortgage early and wants more information on this and want to go, like, we can absolutely set up any time to do that. I'm not hard to find. And if you want more information about financial strategies around your real estate, make sure you follow us and we'll stay in touch and make sure we keep giving you this information. Have a good day.